Ever wish you could control thousands of dollars worth of oil, wheat, or even gold with just a small upfront investment? Welcome to the powerful world of futures trading, where big opportunities and big risks are only one contract away. Want to learn about futures trading? What is a future? Why did it start? Where can you learn what you need to know about contracts? Well, folks, in this video, I'm going to explain what futures are all about with nearly continuous trading opportunities for most of the day and night, including weekends. It is no wonder that many traders enjoy futures. That brokers allow you to trade them on margin means you can make outstanding returns with, for instance, maybe just putting down around 10% yourself. So folks, it's Michael here, and if you want to support this channel, please click on the subscribe button and consider sharing it with people that you think would also enjoy this video. So to understand futures, we really need to know where it came from. That will help us understand them. So it goes back at least as far as Japan in the 1700s with rice farmers. There were even some forward contracts that was private parties one-to-one, which kind of was a precursor to the modern futures, which is more of an exchange, public exchange, that anyone can join in rather than just private one-to-one over-the-counter transactions. If we fast forward to Chicago in the 1800s, which was a giant hub for doing trade internationally at the time, and compared farmers and industrialists in the emerging nation of the US, well, the farmers would be sowing their seeds uncertain of the future harvest and whether they could get good prices or lower prices, dependent on the harvest, dependent on supply and demand, a year from now or 6 months from now or a few months hence. Industrialists, on the other side, were needing to buy the products from the farmers, and they weren't sure either what's going to happen. So obviously the farmers wanted a higher price, the industrial wants a lower price, and they met somewhere between those prices with this idea, well, look, with all this uncertainty, we really can't calculate our margins and figure out what the profits are going to be. So it took away so much uncertainty to be able to ensure this through future contracts. So what is a future contract? It is simply agreeing on a quantity. It could be the number of wheats or bushels of wheat or grains or pounds of copper that are going to be delivered. And it will be at a particular price that they've already agreed upon and at a particular time. So it could be 15 months from now, 12 months from now, you name it. The time, this price, this quantity are going to be delivered at this exact time. So that's perfect. It's locking in security right now. Maybe the farmers could do better if everything went right, and maybe the industrialists could get it much cheaper if the market price crashed. But rather than take the risk, the farmers are going to take slightly less than what they might make, and the industrialists are going to pay a little bit more than what they could pay if things went in their favor. But of course, the farmers are at least guaranteed this price now, rather than if the price dropped even further. And also the industrialists are guaranteed that they can pay at this particular price, rather than if there was, for instance, a bad crop, or if there was a famine or a bad year where the actual crop or the price may actually have skyrocketed due to scarcity. At least the industrialists wouldn't be on the hook for a really high price in that regard, if that was the outcome. Now, the onus here, unlike an option, is this particular derivative contract, you must, so there is an obligation. Unlike with the option, where that derivative, you have the right, but not the obligation to conduct the transaction. Here, to exercise your option. Here, once you've engaged in the future, and once you've actually set the contract up, the contract itself, not the people that hold the contract in the middle term, but the contract itself is set up that if you hold that contract at expiry, whenever that date would be, it could be the 15th of the month, 6 months from now, you must make and take delivery. So it could be that you're actually going to be the receiver of lots and lots of cattle, or you're going to be the person that has to deliver on all these barrels of oil. So beware as a speculative trader that you don't really want to be holding these futures at expiry date. So speculators came into the fray because they were looking at the contract expiry date. They were not really interested in holding it, but between now and the contract expiry, the price would change as time, the world changes, uncertainty changes, events will happen. So they're really betting on price fluctuations between now and that expiry date. They do not intend to deliver the actual asset. They just tend to buy and sell during that period and profit on the fluctuations of the price of the future in between when it was originated and when it's the expiry date. Now, the notional value was the price quotation, so that is the price at which it's quoted, and usually that means that it's down to a certain amount, times the contract units. So it could be that you have to supply hundreds or thousands of pounds or of barrels of oil or cattle, etc. So the price quotation times the contract units is the notional value. But these speculators are not really trading on notional value. The speculators are placing bets, but they do not intend on delivery. So brokerages allow us to have a certain amount of money that's insured, that's there, if the position goes against you. So you may trade in a contract. For example, the ES1 notional value could be $200,000 worth. But the brokerage might allow you to trade with 10% of this, or only 20,000. So you can be trading something that's in the value of 200,000 with 20,000, and this is where you can get a lot of room for profits. So most futures trading is indeed on margin. So it is vital that you research the margin requirements of your individual broker. Now, in terms of the exchanges in Chicago, it's mainly the Chicago Mercantile Exchange, or CME. In London or Europe, it's the Eurex. So you could start by Googling the CME group copper or wheat or oil contract specs, and note that it's probably trading around about 23 hours a day. You could see the contract unit, so the units in which the wheat is bought and sold, the number of bushels of wheat or the number of pounds of copper. You could see the price quotation. You could see what is the actual notional value, so that's the multiple of the contract unit times the price quotation. But again, we don't really want to be holding the contract until expiry. Now, the tick is the minimum difference between the bid and the ask, so the buying price and the selling price. So it could be that $100 is the buying price or the bid price, and the ask is $100.25 to sell it, so the tick or that difference is 25 cents. Well, if there's 100 minimum amount of units, that's going to be 25 cents times 100, or $25. So $25 is the minimum profit or loss that you may make if the price moves. Every tick in your favor makes you about $25. The product code allows it to follow the product. There's also a list of contracts, but it gets less liquid further out. So you don't usually want to do this as a retail trader. You really want to go to the first contract mostly. And then around the time it gets towards expiry, you want to move on to the next. Now, the settlement method, it could be, for instance, if you're trading with something like the index, the S&P 500 futures or the NASDAQ futures, that you can probably settle with money. It's not the same with oil or cattle. You could suddenly have a bunch of oil barrels arrive in your room, or cattle arriving in your driveway. You don't want that. So you can really be on the hook. It has happened to people before in the past. So be very careful, not as a speculator, not to be holding on to these contracts until expiry. You don't really want to be taking delivery. Now, there's also the termination of the contract, which is usually sometimes, for instance, on the business day before the 15th of the month of the contract. So the termination of the contract, usually it's the business day before, for instance, the 15th of the contract month. So if it's December, then it could be the 15th of December. This could be right now, you could be looking at this in August, so that's what you're looking at, a 4 months contract, and it's due 15th of December, or at least the business day before the 15th of December. When you're a beginner trader of futures, you don't really need to know too much about the trade at settlement, or TAS, or position limits. It's unlikely for most of us that are not yet trading in the millions of dollars worth. But a lot of prop trading firms, they are interested in settlement at the end of the day. They can make some profit. Now, in terms of practical things, we can think about, let's say if we're looking at copper, we can look at the minimum size, the number of pounds. We can look at the minimum amount of price flexibility, which is also important, and the expiry date. and when we trade, and the margin requirements. Now, each brokerage differs in terms of the margin requirements. So it's important to look at the broker's site that you're using. As always, it's good to trade paper first, right? You want to be looking at playing in the sandbox. So for instance, if you're moving from trading with interest rates to moving towards something commodities, it could be like precious metals, just be careful, practice. Some of these markets can move very, very quickly, so do not take it lightly in the slightest. Now, in terms of brokers, I particularly like Interactive Brokers a little more than I do TradeStation or E-Trade. I think those can sometimes be better than Schwab or Webull, but it's personal choice. Webull is good in terms of its low commission. They've got low minimum margin requirements, but quite limited selection. You're really just looking at the CME only. On Interactive Brokers, you also get that low commission, but there is a large selection. Maybe the website isn't great, but that's why I just like Interactive Brokers for futures trading. Now, you can use something like TradingView to do some research, some historical research, and try to identify these zones. It's above the scope of this video, but you can really engage, for instance, in things like zone-to-zone trading, but it's important to learn how to trade if you're going to engage with futures trading. So, as we saw, futures emerged in Japan in the 1730s and Chicago in the 1840s, where farmers and industrialists wanted to insure themselves by agreeing in advance on a price, on a quantity, and on a time for delivery. Now, speculators profit off price changes, buying and selling these contracts for profit before the expiry date, and brokerages allow margin trading, and thereby people can make outsized profit. It's important to learn how the contracts are specified and educate yourself about trading. Many of the same trading techniques can be applied to futures from other derivatives such as options and even other asset classes. So if you want to learn more about personal finance and investing, then why not subscribe to this channel? It's absolutely free. And comment down below what you'd like to learn next. I will certainly consider creating one of my next videos on that topic. Well, folks, I hope to see you again in one of my other videos in the not so distant future.